Thank you for that introduction. In listening to it, I think the job I have now is far easier than any of the other jobs I've had. Most of what I do at the moment is travel around the country talking to builders, which is much easier than representing the coal-fired power stations during the introduction of the carbon price. I would have a lot less grey hair if I hadn't have done that. Now, just to begin with a caution, I should have let the organisers know no sharp cutlery on the tables, but I did not. So please sit the cutlery down before I get started. And you should all know that you don't invite an economist along for telling of good news, you only invite an economist along for bad news. But I will note, just hang about until you get to the last 10 slides. I'll go through the last 10 slides quickly, but they're the important ones. They're the big picture stories. We've got a lot of problems ahead of us, particularly for the building industry, and I will talk a lot about detached home building today because they are the core of HAA's members. But we also represent apartment builders, and we have amongst our membership most of the commercial and civil construction membership as well. I'm going to begin on this slide, as I always do, just to give everyone a context of quite where we're at. This shows the history of the number of homes commencing construction in Australia over the past 15 years and our forecast going ahead to the end of the decade. So just for context, so we've got multi-units and detached there, detached at the top in the black line, multi-units in the green line. Now, you can see that enormous bubble of work that we've just gone through. We call that the home builder bubble, or the industry's been very aptly described as being like a snake that swallowed a wombat. There was an enormous volume of work came into the pipeline. The industry is having trouble digesting that at the moment. We can talk about fixed price contracts, insolvencies in the industry, but that's just about past. We've just about digested that huge bubble of detached work. And you can see going ahead there our forecast in that little dashed line coming down over the course of the next 18 months to a trough, middle of 2024, before picking up to some solid numbers 2025, 2026, and then we just revert to long-term averages. Multi-unit apartments, so you can see in that green line there, I know that green line, when we look at it in 10 years' time, isn't going to be in that nice, flat, smooth line that you see there. We can't pick all the peaks and troughs of home building multi-unit apartment commencements, but the long-term outlook has to be positive. 3.5% economic growth, 3.5% GDP growth, and population growth somewhere north of 300,000. We have to build more apartments. So that's the macro story. Now, I'm actually very proud of that graph. We produced these forecasts in the middle of 2021, and we've scarcely changed them. We have, in the past 2 weeks, we've just revised these forecasts, and that trough there in the detached graph, this trough in the middle of 2024, we've brought that down. We've pushed that peak up a little bit. The reason we did that was that the cash rate went higher than we had anticipated. I didn't think the December rate increase would occur. I didn't think February or March would occur. So in light of that and any future increases, what we see is that trough coming down and the peak on the other side coming up. The number of homes we build over the course of the decade doesn't change. It's just when they occur. And unfortunately for building, we see the worst of the peaks and troughs. Building industry moves more significantly compared to the rest of the economy. And unfortunately, the roller coaster ride is going to continue for the next couple of years. Just to give you a heads up, I'm going to finish on these slides, so you'll see them again a second time, and I'll certainly make sure that everyone can have access to them afterwards. There are a few slides that are just in here for background information that some people may be interested later, but you can see here that green bar, which is detached homes. We have a very poor outlook for what's happening here in Sydney, not just constraint on land, forcing up land prices and forcing people out of the market. Not just increases in construction costs due to regulation forcing people out of the market. Not just due to the labour shortage, increasing the cost of construction forcing people out of the market. Not just increases in interest rates forcing people out of the market. It's all of those factors at play. Now, 20,000 detached houses in Sydney. Sydney sees the worst of rate increases. Most sensitive to access to finance constraints. So this market sees the worst of what we've got in this cycle. But you can see there those bars, those black bars, they're essentially high-rise in Sydney. The bulk of those are high-rise in Sydney. And we have to be on a very different trajectory, despite the most recent history. So I'm going to hit you with our latest data. Then we'll go into some of the macro problems. I'm going to finish up then going back to the bigger picture issues and some of the politics. We survey the largest 100 home builders in the country every month and ask them how many homes they sold and a bunch of other questions. Sales of new homes in New South Wales, or this is nationally, down nearly 50% on 12 months. In New South Wales, of course, seeing worse than the rest of the country, down 75%. Now, admittedly, that's made the room quiet, didn't it? Admittedly, that 75% is coming off a very high base. And secondly, there is a lot of disruption to the market at the moment. It's not just from customers and demand pulling back due to higher interest rates or access to finance. It's also due to the problems builders have at the moment. Completion of homes, and I'll come to that in a minute. And so all states and territories have pulled back. Sydney more so than others. We're about to see Melbourne or the Victorian market pull back in a similar fashion to what we've seen in Sydney over the second half of last year. They're just 3 to 6 months behind Sydney. When we look at then who is pulling back, it is owner-occupiers, mums, dads, sea changes, tree changes, retirees, investors, upsizers, downsizers, first home buyers. Every aspect of the market is pulling back at the moment. We'll go through in a minute quite why, but I'm not deeply concerned by that, but I am concerned by this graph here. This is the number of loans issued for the purchase or construction of a new home, and it is at its lowest level in 15 years. Now, there are two reasons for that. One, understanding the data, is that we're looking here at commencements for detached homes and completions for multi-units. And we hit just a little spot where all of these numbers converge on very low numbers. The second thing to remember is deep, dark, dangerous, treacherous lags. And that's a long story that we've been telling for the past 12 months. As you can see, we started this cycle in December 2021. We've since then had 10 rate increases. But we don't fully see the impact of the May 2022 increase in the cash rate until the middle of next year. It's 2 years, 2-year lag. And certainly in our narrative to the Reserve Bank, and I'll say at the moment we're seeing them every fortnight and sharing data that unfortunately I can't share with you today, which shows just how quickly the market is hollowing out at the moment. And unfortunately, they are waiting until they see those numbers in unemployment and GDP figures, which is a dangerous situation for us. And so that is why you will hear some, publicly, it behoves me to talk down the building industry. But certainly at the moment, we have plenty of data to support the hollowing out of building activity at the moment. So now those figures there, that is actually through to January this year, and I don't expect that we will see the bottom of that until maybe June of this year. We're going to still see that tracking south. That doesn't mean that we see the lowest number of housing starts, just means the work coming into the pipeline is slowing quickly. Now, this is the chart that Federal Treasury are the most interested in. This is our forecast for starts and our forecast for completions. And what we're really interested in is that bar chart underneath those two graphs. That shows the volume of work underway. Now, we've been advertising for economists to join our team in Canberra since about June of last year. I've got 2, maybe 3 positions available if anyone in the room is interested. And I understand that it'd be a pay cut for someone for the building industry to become an economist. But for those of you who made poor life choices and went to university, there is an acute shortage of economists in Canberra. And part of the reason is because of this. You can see there that 1 in 10 Australians are employed in building and construction. There is almost twice the number of homes currently under construction as we've ever seen before, which means that the building industry is absorbing every worker there is across the economy. It probably peaked in December last year, and we'll see it tailing off, but you can see that our forecast there is to the end of 2024, and only at that point are we starting to get back to an average number of homes in the market. So Federal Treasury are interested in that because that's what unemployment figures look like. Their unemployment figures don't get astoundingly large until we finish building all of these homes. Now, this will happen reasonably quickly once we see work entering the pipeline slow, as you can see up on that slide. From a product supplier perspective, this graph is also very relevant because it is work underway that reflects demand for building products. And while work commencing begins to slow in the second half of this year, because of this volume of work underway, it doesn't affect material demand until sometime in the second half of next year. This is what that graph looks like for semi-detached, a very small segment of the market, but you can see it following the same trajectory. Shortage of housing stock, finally seeing an increase in that demand or the number of semi-detached apartments under construction. And when we get to then multi-units, completely different trajectory, in fact quite the inverse of what's happening on detached housing. We're unlikely to ever see a return to this 2017-18 cycle. That was the repercussions of Bob Carr's Sydney is Full speech. We finally saw state governments intervene and pull back on planning schemes. We saw a huge flow of demand for apartments come through. Since then, those planning regimes have gradually wound back, tightened up. Cost of construction has increased. It's not a decline in demand. Demand is still there if it can be delivered at a price. But we're not going to get a return at any stage. I'm not going to talk about land prices. Land's become incredibly expensive and there's very little of it. I'm not going to talk about labour shortages. It's acute. Instead, I'm going to have a talk about the most boring topic we can, which is inflation and interest rates. And I do everything I can not to talk about it, but it's the only thing that we need at the moment. Cheers. Thank you. Now, the Reserve Bank, of course, have said a few things such as rates won't go up until 2024. They've spoken about the terminal cash rate. Yesterday they came out with language that says maybe a pause is in the near future. Our forecasts assume rates continue to increase at 0.25% through until May, and that we see then a 6-month lag before house prices start to rise quite quickly. As soon as they stop increasing rates, confidence comes back, people turn up, volume of transactions happen, customers will turn up buying apartments and homes. So September should be the bottom of your cycle for new home sales, new unit sales. March next year we get our first cut to the cash rate. Bottom of the cycle from a starts perspective in the middle of next year. Gradually pick up over the course of the next couple of years. The reason we have that forecast is we can see fairly clearly from the Reserve Bank's historical patterns how they behave. And I'm going to run you through 2 cycles because only 4 times in the history of the Reserve Bank have we seen them substantially increase the cash rate. Now, this time is faster than we've ever seen before, but the trajectory is fairly consistent. I'm going to focus on 2 times. One is 1994, so after the recession we had to have, and you never need a recession. We didn't need one in the early 90s, and we don't need one in the future. Any economist that talks about recessions hasn't lived through one, and they are never necessary. I'll come back to that in a minute. But what we saw there, a 3% increase in the cash rate over the course of 18 months, leading to a 30% drop in building activity. 6 months after their last rate increase, they cut rates 3 times. Home building picked up. You can see the upside there. Next time is 2012. Post GFC, increased the cash rate by 1.25%. Caused building activity to stall, dropped to 40% over the course of 18 months. Then they cut the cash rate 3 times, stimulated home building out the other side, picked up the rest of the economy, drove the national economy forward. Likewise, in this cycle, we've now seen 10 rate increases. We're expecting a 45% decline in building activity, so larger than we've seen in previous cycles, mostly because we're coming off a higher high than we have in previous cycles. And likewise, 3 cuts to the cash rate from early next year, middle of next year, home building activity will pick up. So that's the cycle that we're looking at. And the question we keep getting is the terminal cash rate. What is it going to be? We're working to an assumption that the terminal cash rate is 4%. And most builders will say, yes, that is fairly terminal for us, but that's not the way that economists mean that term. And I am going to just quickly run you through just a little bit of a little bit of a lesson as to what CPI, inflation, and the Reserve Bank are up to, and why you shouldn't listen to it too much. We haven't had this education on what inflation and CPI is since the 90s, and it is a very poor measure of what's going on in the economy. This is what the composition of the CPI basket of goods is. Every month, the ABS pushes a trolley down the road, and they fill it up with these items. The biggest item is housing, not surprisingly. And last year, the cost of housing, and particularly construction, went up faster than anything else, around about a 20% increase in the cost of construction, which is why we saw an enormous increase in inflation. But what's happening now is a very different cycle. So 20% increase in the cost of construction last year. We're looking at around about 10% increase in the cost of construction in ABS figures. Most builders have already seen the bulk of that 10% increase. You guys are running quotes ahead of what ABS are reporting. And this year's cost increases, yes, we've seen timber go up by 100%. It's come back 20, maybe 25%. But other building materials, particularly cement, glass, aluminium, anything that is energy intensive, we're looking at increasing in price this year, while a lot of other commodities come off. We don't get to a cycle where we see a fall in the cost of construction. It's happened 3 times since 1970, and each time we had a fall in the cost of construction, it was just marginal. And we're not in this cycle as well going to see a decrease. And that's partly because at the end of this year, we see a range of new energy efficiency and disability measures come into place that are going to increase the cost of construction again. Yeah, you're sweating on plans at the moment, are you? Yeah. Yep. I'm not going to talk about changes to the National Construction Code. I can spell NCC, and that's about the limit of my knowledge of it. I do know the numbers that come through in terms of increasing cost of construction. The other thing to know about inflation is what's the problem with inflation. The reason the Reserve Bank and the government don't like it is because it reduces the competitiveness of your economy. That was the problem we had in the 1980s. We had high inflation, the rest of the world didn't. Our economy was becoming less competitive. The Reserve Bank increased the cash rate. That slowed the economy. The federal government spent more money to stimulate the economy, so the Reserve Bank increased the cash rate, and then the government responded by spending more money to stimulate the economy, and eventually it fell over in 1991. I don't think we're heading down that same path again, partly because of this graph. This is not domestic inflation. Australia is not losing competitiveness because we have high inflation at the moment. We in fact have very average inflation. This is a global cycle, not a domestic cycle. The Reserve Bank increasing the cash rate to stop inflation in Australia is a little like sticking your hand out the car window in order to slow your car down. It's going to be very ineffective. Inflation is only caused by 2 things. It is the government spending too much money and the government printing too much money. They stopped printing money early last year, and the spending is continuing. I'm going to leave that for Paul Nicolau to sort out. But we are sweating on this year's budget to see spending slowed, and that is the inverse of the cycle that we saw in the late 80s. Now, the next couple of slides I'll skip over quickly, just go more to this international story. That just shows you that inflation in Australia in the long term is almost identical to what happens to inflation in the United States. That says inflation in the United States last year went from close to 10% to 1% in the second half of last year. That correlation between Australia and the US is broken, but it will return very soon. In terms of inflation, if we break it down into 2 types, both of them are bad, but there's short-term inflationary pressures, which is what we've seen, supply chain disruptions, pandemic. It will pass. Then we have the problem of embedded inflation. Embedded inflation is a real problem for every economy. But this is the Reserve Bank's own data, which says almost all of the inflation we have at the moment is short term. There is a risk that it transfers to long term, but I think that risk remains very low. But one of the problems the Reserve Bank has at the moment is that the way households responded to the uncertainty of the pandemic was to protect themselves by building up a buffer. There was an enormous wealth transfer through the pandemic of federal government money to households. You may not feel like you're wealthy, but on average, which is all economists are interested in, on average, you're wealthier, significantly wealthier. The average Australian household put an enormous amount of money into their mortgage offset account, which means that the impact of the rate increase over the past 10 months is very muted. The Reserve Bank are not seeing that flow through to changes in consumer behaviour. The Commonwealth Bank put out some data this morning on credit card usage. And I think that it's a really good metric to look at. And what we can see in that is since probably November last year, expenditure has slowed 7 to 10% to be about 30% higher than what it was pre-pandemic. So households are still spending, and it's because of that chart, because they still have that buffer. They've paid down their mortgage despite the higher cash rate. They're able to withstand that increase in the cash rate. It's going to change. As you can see on this graph here, that red line continues up. That really only reflects the November rate increase. We've still got 3 more rate increases to flow through to fortnightly mortgage repayments, and then we're going to have whatever the Reserve Bank does in the future. But this is the one that the Reserve Bank are sweating on. Now, as soon as inflation is reflected in wages, we're looking at a structurally higher cash rate over the course of the decade, which is why we revised down our forecast just 2 weeks ago. It does look like there is some embedded inflation coming through, some higher wage growth now. Nothing to be concerned about at this stage. As you can see, returning to wage growth at 3 to 4%, that's a healthy, balanced economy. But if it continues beyond that, there's certainly something to be concerned about. I mentioned household savings. You can see that official data would suggest that households are still saving. Their confidence is very low just because they keep reading economists like myself talking bad news in the media. But when we look at what they're actually doing, as I mentioned, that credit card data, that's retail expenditure. They haven't stopped. Little drop off at the end, which I don't think is real. Households are still cashed up. The economy's not broken despite 3.6% cash rate. Just going to take a little diversion, and this is a pet issue of mine. We talked a lot about this in 2019, the credit squeeze it was then, lowest level of home building in the Sydney Basin here for decades. It was a little bit of a dark horse for home builders. It's a terrible thing. I try and, the greater the expert, the simpler the explanation. I try and put this in language that every builder in the country can comprehend. But unfortunately, every time I talk about macroprudential restrictions, I'm unable to find an easy way of explaining it. But it is something that causes the industry harm, and it, to me, is a social harm that does require intervention from the government. This is what happened to lending during COVID. So we all know those that owned a home at the start of COVID, house prices went up. Those that owned the most homes made the most money through that cycle. The haves got more, the have-nots got less. Then we had this in addition to that, which is lending for those people with a 5% deposit fell during the period. 1% cash rate, but lending to that cohort fell. You had a 10% deposit, your lending to 10% deposits fell. Lending with anything less than a 20% deposit fell. Meaning if you didn't own a home, it was house prices were going up and I'll say banks, but in reality it's governments. Governments were making it harder to borrow in order to buy your first home. The only cohort of people that saw an easing in access to finance were for those that already owned a home, reinforcing that bad social outcome of what we don't want. And this is the reason why. Since the GFC, the amount of capital banks are required to hold in order to lend to mortgagees has almost doubled. You've got to ask why. The GFC was a US problem. Basel 1, 2, 3 and 4. Basel 4 was introduced on 1 January this year. We're still paying the price of the US housing bubble in 2007. And you have to ask why. This is mortgage delinquency in Australia, and I apologise, they changed the way they collected the data last year, so you go from a line graph to a bar graph to demonstrate that. But 0.4% mortgage delinquency. We can't get that number any closer to zero. It is astoundingly low. The main cause of people defaulting on their mortgage is sudden unemployment. Until we can stop businesses going broke, that's not likely to go to zero. And the second cause is people getting divorced. So until economists can fix marriage problems, we're not going to get that number any lower. Governments can't continue to force first home buyers out of the market and expect home ownership rates to improve. As an investor looking to buy an investment property at the moment, you're being assessed against a cash rate of nearly 10%. It's an astounding restriction. I've turned up to have to check on the same income 12 years on. The Commonwealth Bank will lend me half of what they would 12 years ago. That makes no sense. And that's the consequence of it. Home ownership rates in Australia have been falling, and they will continue to fall until those macroprudential restrictions are eased. Now, within 3 months of the last increase in the cash rate, we will see APRA and ASIC come into the market and ease those macroprudential restrictions. They brought them in as some emergency measures. The one that always gets the headline is the 3% buffer. The UK has removed their 3% buffer. I think New Zealand, the US have done as well. It's still in place in Australia, but the 3% buffer is a bit of noise. It's the easy one to talk about. There is just all of the other restrictions that we have seen for 15 years that make it increasingly expensive to lend to first home buyers. I'll hit this one quickly. I think we've killed it. But you continue every so often to hear stories about the credit cliff, the looming credit cliff. I've forgotten the numbers now, but X number of Australian mortgage holders are going to go from a fixed loan to a variable loan at some stage this year, and there's billions of dollars that it's not true. The last time they ran the story was 2017, and it wasn't true then. It ran in 2012, it wasn't true then. We have an incredibly stable, conservative, reliable, robust financial sector. We will go through this cycle reasonably smoothly. So that's the end of the bad news. I get to the good news now. And I'm going to skip through the good news very quickly, but the good news is the only things that really matter. And the good news is 3.5% GDP growth. That's the Reserve Bank's forecast. They're not worried about the future. The Australian economy is bulletproof from everything other than a self-inflicted wound. If the rest of the world goes through a recession, as appears likely, that's a good news for Australia. This is not the 80s anymore. In the 80s, the line was the US sneezes, Australia catches a cold. That's not true. Asian financial crisis, the rest of the world pulled back, we boomed. GFC, same story. Pandemic, we boomed as well. Every time the rest of the world contracts, their federal governments spend more money on infrastructure, which leads to demand for coal, iron ore, cement, anything Australia produces. The same will happen in this cycle as well. If you go around Perth, Scarborough Beach on a Thursday night is still covered in people in green Shamrock rugby jerseys, because in the time of the last global recession, around that 2012 cycle, Perth was booming. The rest of the world was contracting. We were drawing workers out of every other part of the country. Part of the problem we have at the moment is the rest of the world is booming. We're trying to build a lot of houses, build a lot of infrastructure, and we can't find people to do it. A global recession will be positive for that outcome, because finally we will have somewhere to draw workers from. At the moment we can't attract them here because they all have good solid jobs in the rest of the country. But a recession in Ireland will see a lot more Shamrock jerseys back in Perth. Unemployment rate at 3.5%. I can see a little dip at the end there. Maybe that's a bit of a slowdown from the Reserve Bank increases in the cash rate. More likely it's just a drop off as a consequence of a return in migration. Which brings me, we're exporting more than we've ever had before. It's dropped down over the last couple of months, but there's nothing to worry about there from an export perspective. Which brings me to the migration story. In the John Howard era, we were bringing in net about 220,000 people per year. That slowed over the course of the next 15 years to around about 175,000 in 2019. 220, 175. Jim Chalmers has flagged that number goes to 300. Westpac are forecasting that number to go to 400 this year. That's more than a doubling in the rate of net overseas migration. That's not okay. It's very good from a macroeconomy perspective. It's not a surprise. It was built into our forecast at about 300,000, not the 400,000. What we do want as an industry is stable and reliable population growth. And what we do have is the government pulling back on that lever. The reason they're pulling back on that lever is that it's the best way to ensure that they look like a good economic manager at the time of the next federal election. And growth in population will achieve that outcome. It is the right thing to do. From our industry's perspective, though, it's going to cause us some problems. As you're well aware, there's an acute shortage of rental accommodation everywhere in the country. Most people are aware that there is one in their city. If you travel along every little town from here to Cairns, as I do, every local newspaper has stories about the cohort of subcontractors in the building industry living in caravans down at the beach. There is an acute shortage of accommodation everywhere in the country. There's also an acute shortage of accommodation in the rest of the world as well, which means the next federal election, 2 years away, I don't know what the number one issue is going to be at the election, maybe the cost of living, but certainly in that top three is housing affordability. And there's not much we can do as an industry when the Reserve Bank is forcing home building down, population is doubling, or population growth is doubling, housing affordability is going to be front and centre. Now, that's undesirable from a political perspective because you don't want governments making policy decisions during an election cycle. Now, the federal government's done some very good things. I'll finish on the migration story. Sydney. One of the problems with migration data is it is so deeply lagged. The most recent data out of the ABS is to the middle of last year, which says the number of people arriving in Sydney are 25% higher than they were pre-pandemic. Now, given that that's probably doubled to now, there's an enormous number of people turning up looking for an apartment in Sydney. The federal government have done a lot of good things, and this 1 million homes per year, I forgot, when did I join the HA? That was an introduction at 2003. We've been talking about demand forecasting. It's only taken 20 years, but finally the government have picked up on demand forecasting. Federal government are now doing demand forecasting. New South Wales state government does not do demand forecasting. How is that possible? That your state Department of Planning don't know how many homes they're going to need as a consequence of 400,000 migrants turning up this year. The structural problems we have are acute. They are going to take a decade before we get to the end of this, but Housing Australia, 1 million homes per year, they talk about a very unsexy term of data, and I am a chief advocate of we need better data. The data for housing is terrible. No state government can tell us how much land there is in the pipeline. We keep asking them to report against 7 stages of land. We're getting there. The Queensland government had an attempt at it last year with a report called their LSDM. It's worth having a look at. There's a complete disassociation between the executive summary and the data that sits at the back. The minister's told we have 15 years worth of land supply. You look at the data at the back and go, you've got none. When you report and it's publicly exposed, then we can get progress. So data is important. Housing Australia, there's a lot of good initiatives that are coming through that. The federal government's 50,000 homes, public social housing, it's a good start. More public housing is certainly required. The other topic that comes up is build to rent. Now, build to rent, there's 2 sides to this argument. One is that it's acceptance of failure. We have forced people out of home ownership, and therefore the only option is long-term rental accommodation and subsidising public housing through the private sector to build long-term rental accommodation is an indication of loss. There's some truth to that. The other side of it is that in France, 97% of homes, new investment homes, are built to rent or built by institutional investors. 87% in the US. In Australia, that number's really close to zero. And that's clearly a problem. We have the finance there. Housing is clearly a solid and stable investment. And the work the government are doing to encourage build to rent, in economic theory we call it the infant industries argument. And there is certainly merit in attracting institutional investment into housing in Australia. And they will get some more homes built. Not a lot. They're looking at 50,000. They think that 50,000 is 50,000 in addition. And I don't think it will be, because I don't think planning regimes will permit 50,000 additional homes over a course of 5 years. It will be some crowding out. Nonetheless, we're looking at, over the course of that period, that they will only get to about 952,000, not the million. But let's hope we get past that million. It's going to require some state governments to be broken along the way. Skipped over a couple of slides there. If you're wondering about house prices, don't. They go up, they go down. There's a bit of talk that they've stabilised, they're about to go up. It's not true. Probably got a little bit further to come down before 3 to 6 months after the last rate rise, your house prices are going up in Sydney, and they'll go up very quickly. The fear of missing out kicks in. All of that churn happens again. People get excited, and it's on. There is nothing fundamentally broken, and the reason is there's nowhere left in the country to rent. This is my little slide to make sure I covered off everything. I haven't touched negative gearing capital gains tax. Touched the wealth inequity one. Negative gearing capital gains tax, of course, you can't make houses cheaper by taxing them more. The really good thing happening out of this New South Wales election is both parties are going to the table with cuts to stamp duty. It's an excellent, every other state and territory should be looking at that. That's probably all I'll say on negative gearing capital gains tax. I'm just going to skip through the next lot of slides there for background for anyone that's interested. Essentially, what you're looking at here, you're trying to see that dotted line is above the solid line. That means there's more work in the pipeline. Looking at renovations work here, and our renovations forecast is quite different from our forecast for detached homes. So as I mentioned, we're looking for the dotted line to be above the solid line. Here we go. There's the reno graph. As you can see, our forecast for renovations is very different from that for detached homes or for multi-units. The reason for that is the acute land shortage means that building a new home is increasingly difficult. If you specialise in knockdown rebuilds, 2023 and 2024 are going to be the year of knockdown rebuild. There is no land left. If you already own a block of land, you'll be ahead in the pipeline of getting a home built. But renovations continue. For most of the population, we've seen a wealth increase. Still cashed up. We can't move. Therefore, improving the quality of the dwelling you're in. It's a trend that's happened globally, so we do have it slowing but remaining well above what it was historically. And then again, we're looking for that dotted line to be above the black line. And in no metric, particularly in New South Wales, do we see that dotted line above the black line. That's total dwelling approvals over the last 12 months. There is no good news in that. It's a bunch of data in there for those that are interested. Now we're back to the very first slide I started on, which is our long-term or our 3-year forecast here for Australia. And finally, our New South Wales forecasts. And I'm going to finish up on that slide and take any questions. I usually try and have giveaways when I do these events to encourage the first question, but it seems like a very smart and astute crowd. Everyone's wearing a tie except for myself, so I'm sure there's no problems with coming up with a question. So thank you, ladies and gentlemen. Yep.
Team, thank you for your time this morning. The housing affordability is the talk of the nation at the moment. The housing affordability is the talk of the nation at the moment. Probably we all know more than 1/3 of the cost of the apartment or the houses is fees and charges, plus other conditions attached. And we all know the culture at the planning department. We've got a serious culture problem over there. On top of that, we face an enormous problem, centralize the service in cooperative and coordinated approach is delaying the process heavily. Thank you.
Yeah, I'll take that as a statement, but so how to fix that? Not a single planning regime in the country that I can find has as their number one goal improving housing affordability. Not a single planning regime in the country has as their number one goal improving affordability in the country. How is that possible? We have no one left within government who is tasked with that job. The NCC changes, for those that aren't across it, accessibility, it's a great thing. Energy efficiency, a great thing. The cost-benefit analysis did not stack up to do it. Nonetheless, we've done it. Not a single state minister anywhere in the country was arguing for first home buyers. I'm not sure how this is possible, how we've got to this point. But Housing Australia, as its charter, should have housing affordability as its number one goal. From there, the goal should then be to get that filtered down through all states and territories. But yeah, affordability is fundamentally broken. Planning regimes don't have as their goal improving affordability, and as a consequence we find ourselves in this situation. Increasing, you mentioned apartments there. I think it's 37% of the cost of an apartment in Sydney is taxes, fees and charges. Off the top of my head, the Reserve Bank estimated that the cost of adding a floor to a high-rise in Sydney is $180,000 per unit, whereas the cost in Brisbane is about $80,000 per unit. Why is it $100,000 more expensive to take up that airspace in Sydney than it is in Brisbane? 3.5 years to turn a dairy farm into shovel-ready land in Adelaide, 10 to 15 years in New South Wales. Part of what Housing Australia's job should be benchmarking. Benchmarking is a very unsexy economic term. I'll explain it this way. The problem with Australian housing is that we don't have enough capital cities. Hear me through. Brisbane would be the 8th largest city in the United States. Our third largest city would be the 8th largest city in a country with 10 times the population. We have a very small number of very large cities. They are cumbersome to plan, cumbersome to service. The United States has a lot of cities. I know I'm an economist from Canberra telling we need more cities like Canberra, but it is the answer. 500,000 people. Imagine Brisbane as 5 separate states where Rockhampton, Mackay, Cairns, Townsville were all cities of 500,000 and competing to attract workers. There would be competition for the provision of more affordable housing. But we don't have that. We have a few unicorn cities. We've got Townsville, Newcastle and Wagga Wagga. Unicorn cities have 3 things. They have a large university, a large hospital and a military base. They survive recessions. If we look at what happened in Townsville and Mackay, 2 cities just a couple of hours apart during the cycle post-mining boom. Townsville, government town, continued through. They had the highest unemployment in the country, but house prices scarcely fell. That's because while one person in a household may have lost their job, the other had a job, typically a public service job, and the economy cruised through. Mackay lost a lot of people. And even now, despite mining activity being back, house prices aren't picking up there because people lose confidence in that market. So I argue we need more capital cities, and I know that whether that's more states or less local councils, it's an irrelevant discussion. But in economic theory, in the absence of competition, what you do is benchmark. And we need to benchmark planning regimes around the country against each other in order to essentially name and shame state governments and local councils, because no one is representing first home buyers. Paul.
Tim, fantastic presentation, and thank David Baer for allowing you to come and speak today. It's fantastic, and congratulations to the Chamber as well for having you. My question is, the federal government announced they're going to have 1 million homes in 5 years. Is that achievable? I can't see how it is when we've got a shortage of tradespeople, a shortage of bricks, shortage of a whole range of other pieces of... I just can't see it happening in 5 years.
It's absolutely achievable. We've built 1 million homes in 5-year periods repeatedly, particularly that 2017 to 2019 or 2018 phase. Are we going to? No. And that is, again, land supply. I think detached housing starts, 150,000 last year. 120,000 the year before, 100,000 before that. But through all that cycle, we've completed 120. So we can start any number of houses we like, 120,000 detached homes. 3 years ago here in Sydney and Melbourne, apartments were completing 100,000 a year. So you put those two numbers together, that's 220,000 homes per year we can sustain. We've done it before. We did it for 3 years, 2017, 18, 2016, 17, 18. Land, regulatory costs, planning regimes, and a willingness to do it, and it can be done. We're not going to get there by building more public homes. We definitely need more public housing, and the more we force up and force out first home buyers from the front of the end of the market, the more public housing we're going to need. So it is a little like saying we're going to put a man on the moon by the end of the decade. They've laid that out there as their mission statement, and it is an excellent JFK-esque goal. They've now set up the institution to do it. They're haggling over whether the fund is $10 billion or $20 billion. I hear the Greens saying, typical approach to Greens policy negotiation, the amount of expenditure should be double. And they're asking for that. That legislation is before Parliament at the moment and looking for minor party endorsement. And I suspect that by the time we get to this, so the other thing it does, my pet issue is demand forecasting. Governments are terrible at it. What we have built up over the past couple of years is some capacity within Treasury to accurately demand forecast. If we have an organisation where they have some representation and some power, then yeah, in theory, we can get there.
Anyone else with any further questions? We've got time for a couple of questions more, so yep.
Tim, just in regards, Joe Risk from the Arab Bank, just in regards to previous cycles where interest rates by the RBA have been moved up, the pattern has always been that there's a bit of overkill, and then it takes longer to come out of the downturn, if you want to call it, right? Not necessarily a recession, but the downturn and the slowness. And this seems to be very common in terms of not just the RBA, but central banks throughout the world. What's your view on that?
Why do they keep making the same mistake? June last year, I laid out what our press releases were going to say until June this year. And our June press release was actually moved forward to February. And Thursday next week, you will hear some commentary from myself publicly that will be, I'm going to term it, it's the belling the cat press release. It's where we say, hey guys, you've genuinely gone too far here. And that's because what we can see at the moment, we track the number of people that visit display sites, the number of display sites open, number of contracts issued, phone calls made for a group of volume builders in every capital city. And it's fallen off a cliff in the last couple of months. Now, as you point out, we see this well ahead of them. And I will say that we do have fortnightly meetings where we are sharing this data with them. So, and you can see a sentence in their last statement that I think is a direct reflection of that. So the good news is that this isn't like 2020. We hit the pandemic with very little work in the pipeline, and then we fell off a cliff. The line then was parking the ambulance at the bottom of the cliff. That's not where we are in this cycle. And home building, apartments are certainly wearing most of the pain. Detached builders are about to see that pain. But this is a long lead time. We're 10 months into this, and now we're seeing the alarm bells coming through in the data. For the rest of the economy, which is really what they're interested in, then no, we won't see a recession in Australia. We will be quite fine through this cycle. But unfortunately for builders, Yeah, the apartment builders have seen a roller coaster ride, and that's continuing. And the detached guys have seen the peak, and they're about to find the trough. And it's unfortunate that, in terms of choosing an industry, the consequences that the building industry is quite a roller coaster.
Mark Johnston from Lightning Broadband. You've mentioned that... Thank you. Is that on? It is. Thank you. Mark Johnston from Lightning Broadband. You've just made a comment that the number of heads walking through the door in display villages has dropped off, which talks to that detached market. With the apartment market, can you make any comment in regard to stock availability and in terms of maybe how much stock is still out there waiting to be sold?
So yeah, to go through that data a little more detail, Sydney, number of people through display sites, and I will use the word tanked, I don't mean to be inflammatory, but tanked about September, October last year. Melbourne, it's this year. I don't expect to see it in Brisbane. Brisbane's going to slow down. Adelaide's just fine. It is a very mature and stable market is how we describe it. They build 10,000 homes a year forever. And Perth is always our odd one out. It's our black sheep, and they will move to a different cycle as Perth always does. So that's the detached in detail. On the multi-unit front, I don't think that there's anything out there that's been built and for sale. The problem multi-unit builders have is 100% pre-sales required to get construction. We hit a wall the second half of last year, and for multi-unit builders, we saw the number of starts stall, and that's a problem. Migration's strong when we pull back on multi-units. But multi-unit builders couldn't get a start because of unreliability of access to labour or material prices. So detached builders have a problem, fixed price contracts, build time of 7 to 12 months. For multi-unit builders, that's multiplied because their build time is 2 to 3 years. If you can't get a guaranteed completion time, you're not going to start. And so that shortage of materials, the increase in prices, lack of labour means multi-unit commencements stalled in the second half of last year. Now they're all there. They have to start at some stage. There is a lot of people here in Sydney looking for a bed to sleep in at night time. So the second part of that is that talk to the Department of Planning and they'll tell you, why aren't we getting starts? We have double the number of multi-units, high-rise units in Sydney approved, not commenced, compared to 2019, 100% up. Finance is the other component to that. The cost of construction of a new dwelling now is higher than the cost of an established multi-unit, despite the acute shortage, partly because of the increase in cost through the NCC, partly through the barriers to entry with access to finance, and partly due to higher rates. So, yeah, multi-unit builders are finding it really tough at the moment. It's going to turn around reasonably quickly, 3 to 6 months after the last rate rise. I think our forecast for multi-units, you can see, that's New South Wales multi-units, they're 50% higher than detached starts. There is a lot of upside risk for multi-unit builders in Sydney. At some point, whoever the next Premier is here, at some point they do what they did in that 2014 to 16 cycle, which is to intervene and take that responsibility back off local councils. There is going to be far too much political pressure for them not to do that. So, yeah, I certainly feel for multi-unit builders over the last cycle. Yep, I'll leave it at that.